It's known as the One Big Beautiful Bill and is promising sweeping tax cuts and major federal spending to stimulate the U.S. economy. But in its current form, there could be significant tax implications for Canadians who hold U.S. investments. Here to talk us all through it, Nicole Ewing, Principal of the Wealth Planning Office at TD Wealth. Nicole, always lovely to have you with us. And before I start, I'm just going to tell people that if they want to find all the details of everything you've written, this is the report available to TD Wealth clients, and you get into some detail about the One Big Beautiful Bill Act, and specifically Section 899. Can we just start with maybe what is, from your perspective, from a wealth planning perspective, what is the One Big Beautiful Act, One Big Beautiful Bill Act?
It's a lot. So we're looking at, I think, 1,100 plus pages of legislation that includes a number of, say, variant, different topics and interests that would be interested to different people. But certainly what has gotten the attention of a lot of people is this Section 899. And this is the section that is increasing withholding taxes and taxes generally on non-citizens, non-residents who hold certain or receive certain types of U.S. income. So it is going to potentially increase the taxes that are withheld and the taxes ultimately that are due on Canadians who potentially hold this or receive this sort of sources of income.
And that's the part that, of course, everyone is kind of sitting up and paying attention to. And just to quote you here, which is odd to have you on and then quote you, but you talk about U.S.-sourced income earned by Canadian corporations, partnerships, individuals, trusts, and private foundations. And this could have higher withholding rates on dividends, interest, royalties, rents, and pension income, U.S.-sourced, all of those by non-resident taxpayers. And here's the interesting quote, from discriminatory foreign countries. And maybe just stop on that for a second, too, because that's an important 3 words.
So this is, by the definition of the U.S. government, is determining that certain countries are being discriminatory in the way that they are taxing U.S. people. And so, for example, the Digital Services Act and other sorts of legislation that would essentially be saying Canadian and other foreign governments want a share of the proceeds that are generated out of the U.S., but that their citizens are ultimately consuming. So the Digital Services Act, for example, would be one of those. And the U.S. government determines that to be an unfair tax on its citizens. And so this is a retaliatory effort by the U.S. government to tax these unfair foreign governments into essentially backing down from the way that they're taxing the U.S. citizens. So this is a response, or being represented as a response to the legislation of other governments in order to protect, I suppose, the taxpayers in the U.S. But it's going to impact Canadians and others around the world who hold U.S. source assets and income.
Okay, I want to put a pin in that. We'll come back to that at the end of the discussion, because I think it's, to your point, somewhat of a negotiating tactic. We'll see how that goes. I think before we understand what the Section 899 is going to, how it's going to, or potentially could impact Canadians, we need to know what's so today for Canadians when it comes to U.S.-sourced income. So maybe could you just tell us, like, what, because I don't think a lot of people are aware, including myself. I read some of the details and went, oh, I didn't know that. So take us through it.
Yeah, and this is what's so interesting, is that the Section 899 has really generated a lot of conversation about this U.S. withholding tax, and yet many people aren't aware that they are currently subject to U.S. withholding tax on certain types of U.S. income. Now, there are exemptions, and then there are those that, and varying rates. So the exemption. So currently exempt from U.S. withholding tax would be U.S. securities and U.S. listed ETFs that are held in registered retirement accounts. And that's very specific language there. I'm saying retirement accounts. So that's your RRSP, your RIF, your LIRAs. Those are exempt from the withholding tax. Also exempt are qualified interest income on bonds that is either held directly or in Canadian or in US ETFs. Not exempt, so currently subject to withholding, would be the US securities and US ETFs, US listed ETFs that are held in non-registered accounts, but also in your TFSAs, RESPs, FHSAs, and so it's very specific depending on what type of account, depending on what type of treatment it's going to get. Also not exempt would be Canadian mutual funds and ETFs that hold US stock or wrap US ETFs or Canadian ETFs that hold US stock, and also Canadian mutual funds or ETFs that wrap US ETFs that hold international stock. Now, we'll say for a second, on the international side, that's where we're potentially getting into double withholding, because you may have withholding on the international and then withholding on the US. And then ultimately, the distribution would come out to the Canadian taxpayer. Now, critically important here as well is that there are different rates that apply. So the general rate of withholding is at 30%. According to treaty, that is reduced to 15%. So on those withholding taxes currently in your non-registered account, TFSAs, RESPs, FHSAs, that is subject to the 15% treaty rate, and the essentially the RRSPs, RIFs, and LIRAs essentially get a zero rate by treaty, because again, they're treated differently because they qualify as these registered retirement accounts. So a lot of detail there, and it really depends on what type of asset you're holding and in what type of account you're holding it to determine whether or not you'd be subject to these taxes.
I have. We're going to talk to you again in just in more detail, but at a high level, Nicole, high level. What would you say is going to be the impact if Section 899 was passed as is? And I'm going to say the likelihood of that happening is probably low, given what it has to go through still. But if it did, would this imply that it looks as though Canadians will be subject to more withholding tax for the most part, or can you say that broadly or not?
Yeah, we can say that broadly, yes. So the details will matter, but broadly speaking, if this goes through as is, and there is some confusion about what the language actually says, but we would see an increase in the level of withholding tax essentially across all account types, including our registered retirement accounts, RRSPs, RIFs, and LIRAs as well. So there would be a graduated increase of that over a number of years, but generally speaking, if this were to pass as is, every Canadian who has U.S. source income would be seeing the impact of this bill and the changes.
We talked about that there's withholding tax, there is a tax treaties, but we hadn't yet talked about a foreign tax credit, which might be available. Is that true?
That is true. So currently, if you are paying foreign tax directly, you would generally be entitled to a foreign tax credit for Canadian filing purposes. So we're avoiding that double taxation if you've already paid tax on those on that income for U.S. purposes. When you're filing your Canadian tax, you would be able to claim that foreign tax credit. Where things get a little bit tricky for people, though, is again depending on how these assets are held, and if they're in a non-taxable account, like a TFSA, for example, you would have paid that withholding tax before that income was distributed to you, but you would not necessarily be able to then recoup it for Canadian tax purposes because you don't have any offsetting tax. So the foreign tax credit would not have been applicable there. So again, a little bit of nuance.
Nuance that matters, good tax planning matters. So then just make the plug there, Nicole. So, okay, let's keep going. We talked about what exists today. We've got about 5 minutes now to talk about what happens if Section 899 became law as it stands today. And let's just make that assumption, and then we'll talk about why that probably won't happen at the end.
Well, even if we assume that what is written today becomes law, there is still a little bit of confusion, again, just in terms of how things have been drafted, where there's different minds interpret things a little bit differently. So there's still some question there. But general consensus would be that there would be a immediate or delayed, but immediate 5% increase in the amount of withholding tax that would happen over 4 years. So you'd have 5, 10, 15, 20. So maxing out 4 years from now at an increase of 20% of the tax. Now the question is that 20% of the current amount that people would be paying? So if you're subject to the 15% treaty rate, would it go from 15 to 35? Or is the treaty going to be disregarded altogether and now you're paying 20% on top of the non-treaty rate of 30% to max out at a 50% rate? So there's still a little bit of, as a discussion about what the increased amount would be, but generally speaking, we're looking at 20%. And it would be applicable to things that it's not currently applicable to. So the RSP, the RIF and the LIRA, for example, those registered retirement accounts, which currently have a 0% rate, would that rate then be 20% or some different rate altogether? Similarly, the currently capital gains in your security portfolio are not going to be taxable. They are subject, if you hold real property, you are currently subject to a 15% withholding on the disposition of U.S. real property. And this new big, beautiful bill would increase that as well by 20% up to 35%.
There's a lot there that you just said. So I'm processing all the nuance, and I guess, it depends if these things happen. You also take care in your note to say something that equities are less affected by Section 899 because it appears to target income and not capital gains, which you just talked about as well.
Yeah, that's right. So because the nature of the income that you would be receiving really does make a difference here. So by and large, when we're talking about Section 899, we're talking about dividend income. Capital gains, again, generally going to be excluded unless we're talking about capital gains as a result of the disposition of real property. So depending on, this is where we really encourage people to look at the type of investments that you hold and look specifically at the type of investments you hold in a particular account, because there's going to be different withholding tax applying to certain type of registered plans versus others. You're going to have different tax treatments for your dividends versus your capital gains, generally speaking. So we really want to be intentional about the type of investment that we are holding and in which account we are holding it, because for tax purposes, regardless of what happens with the big beautiful bill, currently speaking, it makes a big difference based on the law as it is written today, and it will be amplified if the legislation goes through as is.
How soon could this happen?
So not before January 1st, 2026. So the enacting date depends on the latest of a few different dates, but each of them, if we're looking at the formula that's laid out, it would be January 1st, 2026 at the earliest. If there was a delay in this bill getting out, such that it was not passed or a form of it was not passed before 90 days before the end of the year, then it could be potentially kicked into January 1st of 2027. It's a calendar date that would be relevant here. So the earliest would be January 1st, 2026.
And we also should say, and I don't want to get too much in the detail, it's in your note, but this could also, once it gets to the Senate could change it, bring it back to the House and back and forth. And so, there could be some iterations, although I don't think anyone is at this point fairly sympathetic to Canadians. I don't see it getting easier, but we'll have to see how this all plays out. Is there anything else in the bill that is notable for Canadians you should pay attention to?
Oh, so there's a lot in the bill, and depending on whether you have U.S. citizenship as well, if you're also a U.S. person, there are some rules or new laws that could be impacting you as well. But for Canadian people, current state is that if you hold more than $60,000 U.S. of what's referred to as a U.S. situs assets, which includes U.S. securities, you have an obligation now to file a U.S. return on your death. You need to disclose, or your estate would need to disclose that you held those assets, and there's penalties for not filing that on time. Doesn't mean you need to pay tax, but you do need to file this return. If you do have significant assets, and so the current rate for the exemption, the U.S. exemption amount is $13.99 million. That's the threshold at which you would then begin to start paying tax if you had these U.S. assets. That is set to sunset this year and be reduced to 50%, which could have impacted a number of Canadians who have that level of wealth. The bill also plans to extend permanently an increase in that 13.99 to $15 million. So that for joint spouses filing jointly, that would give it a $30 million exemption amount. So again, the $60,000, we didn't see a change in that. We would have liked to see a change in that because many Canadians will have that filing requirement. But as it comes to tax, if this goes through, we've at least seen an indication by the US government that that US exemption amount is going to increase to $15 million on a permanent basis and then be indexed thereafter.
I've only got 10 seconds, Nicole. It's not fair to ask you this, but I will. So what do you do if I'm listening to you going, okay, like what do I need to do right now?
Take stock of where you currently stand, what you currently hold, what your portfolio looks like, and how you're holding your assets. And then work with your advisor to determine whether or not there's some changes that would need to be made in any event. Make sure that you're optimizing the tax strategies that are available to you and minimizing ultimately the amount of tax that you owe. But we don't want to be making any sort of knee-jerk, quick actions here that are essentially are accelerating tax because we're disposing of things that we don't need to be disposing of. So take a deep breath, look at what you currently hold and get some professional advice to see whether any changes need to be made now and get that proactive advice going forward so that if there's going to be a change, you're working with someone who can help advise and navigate you through that.